yeah, there are pros and cons, right? So I know one big thing that investors definitely need to pay attention to is that their money's going to be wrapped up for it's going to be locked up for a certain period of time while the investment is maturing.
Welcome to the Plan B CRNA podcast. I'm your host, Bobby Jones, and I'm so excited that you're here. The Plan B CRNA podcast is the only show made specifically for nurse anesthetists who are exploring options outside of their traditional career paths. This is the place to expand your mind and your goals as we uncover new ways to produce side income together. Join me for some honest, unscripted discussions with other CRNAs who are transforming their financial lives. This episode is brought to you by On-Call Capital. On-Call Capital is dedicated to educating CRNAs and other healthcare providers about investing outside of the traditional stock market. On-Call Capital also provides opportunities for you, yes, you, to create passive income and generational wealth while also lowering your taxable income through investments in the apartment and alternative investment spaces. If you haven't hit subscribe yet, make sure you do that right now so that you don't miss an episode. Thanks so much for joining me today. And now, on with the show. Welcome to another special guest episode of the Plan B CRNA podcast. Our guest today is a dedicated mentor to investors and entrepreneurs, having taught classes on real estate and mortgage note investing at the CAMA Academy. With a background in corporate finance and over 25 years of real estate and investment experience, Tom Dunkel brings extensive experience to Belrose Asset Management. Taking the company from startup to world-class organization, Tom has specialized in discounted real estate opportunities nationwide since 2006. And Tom's also the managing director of Belrose Storage, a seasoned team of real estate investment professionals that specializes in acquiring underperforming self-storage facilities in the eastern U.S. and turning them around to achieve high teens tax-advantaged returns in a condensed time frame of 2 to 3 years. In his spare time, Tom also happens to play guitar and is an avid golfer. It's such a pleasure to have you here today on the show, Tom.
Hey, Bobby, thanks so much for the nice intro there. Yeah, it's great to be with you and the listeners today.
Yeah, absolutely, man. Well, I want to get us started with a distinction that I think is pretty important to make. So if you would, just talk to me a little bit about the differences between direct real estate investment and fund investments like REITs or any of those kinds of real estate investments.
Sure, of course. Well, again, thanks for having me. I think it's important for investors to understand, the differences in these different investment opportunities. So let's first talk about a REIT, right? The real estate investment trusts. I mean, a lot of those big ones are publicly traded. And for me, anyway, as an investor, high net worth accredited investor since 2006, I mean, I'm trying to get out of the stock market. So, for my real estate investing, I steer clear personally of the real estate investment trusts like the public storages and the extra spaces and those big guys, because that's what I'm trying to avoid. I'm trying to avoid the ups and the downs of the stock market and avoiding my stocks going down because a tsunami hits Japan. I have no control over those kinds of things.
Yeah.
When you go into more of a fund environment, like maybe a smaller specialty fund that might be investing in multifamily or self-storage, I think those can be good ideas. I think depending on where you are in your investment career and your life, it can be a good idea. I guess what I struggle with personally, again, as being an investor now for a long time, full time, I personally am not a big fan of a blind pool situation where I'm putting up, my 100 grand or whatever into a fund. And they may or may not have specific deals targeted at this particular point in time. So my money is kind of going there, and I'm putting a lot of trust that they're going to be able to put that money to work so that I can get my returns going. And so I feel like in that situation, sometimes the alignment of interests of the fund manager versus the investor can sometimes get a little wonky, not all the time, which is why we structure our deals as direct investments. And when I invest with others, which I do often, I like to see that the money's going into a direct deal, a deal that's been identified. It might be one property. I invested in a direct deal, but it happened to be two properties. They were down the street. It was a multifamily deal. But I was comfortable with that because I knew right where my money was going, where my returns were going to be generated from, the market where those properties resided, which is huge, right? I mean, that's a huge factor as investors. We want to make sure we're looking at those markets. And so for me, I think it more closely aligns the interests of the investor and the sponsor if in a direct scenario.
Okay. Well, and I talk with a number of CRNAs and advanced practice providers who have high incomes, but many of them are still stuck in that mindset of stock market investing, and I gotta just put money away into my 401k, and eventually it'll do well. But I'd love to hear you kind of make the case for equity syndications, like multifamily, like self-storage. What are their benefits to the high net worth individual?
Yeah. So again, I think folks that are high achieving professionals, maybe in their own world, they're looking to get out of the stock market. I think if you can find a sponsor that has a good track record that you connect with, I think that personal connection is important. I think it's just a great way to go because there are pros and cons, right? So I know one big thing that investors definitely need to pay attention to is that their money's going to be wrapped up for it's going to be locked up for a certain period of time while the investment is maturing. So like in our deals at Belrose Storage Group, they're typically 2-year deals, maybe 3-year. They might go longer if there's a development component associated with one of our self-storage deals. But as an investor, you can't like click, go to Schwab.com and click and sell your interest in a Belrose Storage Group deal because unfortunately it just doesn't work that way. So I think investors need to be aware of those kinds of things. But at the end of the day, again, I've invested in gold. I've invested in hard money lending. I've invested in residential rentals. I've invested in residential fix and flips. I've done all kinds of things. And what I found in storage is it's kind of the best of all worlds, in my opinion. You've got real estate, right, which is great because real estate doesn't go to zero. For any of us who have lived through the internet bubble back in the early 2000s, a lot of stocks went to zero. It's cash flowing, right? So we have these metal boxes with roll-up doors and concrete floors. It's not a complicated business, but they generate consistent cash flow month to month to month. And historically, Bobby, self-storage has always been very highly occupied. So if you look at the charts going back even like 40 years, storage has this very nice, lazy river kind of bouncing in between, 80 and 90% occupancy from year to year to year over that entire time frame. So I think if I'm an investor and I'm looking to get out of the stock market, I think getting into something that is a little more tangible, a little more understandable, I think will really help with that for sure.
Yeah, well, and I mean, I know that investing in some of these syndications, people want to be invested in real estate, but they don't always want the work that comes along with being invested in, like having a short-term rental or having just a regular rental home. There's a lot of things to do. So, I've always thought of equity syndications as a way to kind of get around that. You get the benefits of that direct investment in real estate. You get the depreciation and all that without the headache of having to actually run the operation.
Absolutely. Yeah, that's a huge factor, of course, Bobby, and thanks for highlighting that. I obviously skipped right over that whole part. But yeah, I mean, we're with Belrose Storage Group. I mean, there's a whole company here. We've got a whole team. Our operations expert, she has over 16 years experience in self-storage. She's seen everything, been there, done that. So she knows how to clean up the delinquency. She knows how to push the rates, right? So even us as leaders in our company, like I don't need to know all those details because we've got a great team that's running it for us. And we track those key performance indicators month after month after month. So if you're a passive investor, you've got a team like that that's looking out for your investment, all day, every day. I mean, that's a pretty comforting feeling.
Yeah, I would say so. Now, speaking specifically about self-storage, what are some of the real benefits and pitfalls that people should be looking out for? Obviously, it's a different investment than investing in an apartment building. Your rent, it comes from a different type of source, and there are different ways that you can produce income as well on the side. So tell us a little bit about that.
Sure. Well, of course, the main way a storage facility makes money is just by renting out the units. But we are also able to layer in with that basically a tenant protection plan. So we have our tenants when they move in, they need to buy into this protection plan, which just adds a few more bucks to the revenue every month for that unit. And when you add that up over a facility that might have 2, 3, 4, 500 units, it really it really helps out that bottom line. And drives those returns for our investors. But yeah, we touched earlier on that it is real estate. It's a pretty simple business, and because it is a simple business, Bobby, our operating margins are actually like in the 60-65% range. So meaning that if there's $100 of revenue that comes in, only $35 or $40 goes to running the actual operation. And that leftover $60 goes to paying off the debt and then to our investors. So it's a very high cash flowing asset class. Again, it's a simple business, and it has great tax advantages. Like a lot of commercial real estate asset classes, we can do cost segregation studies. We can do these other fancy things, but basically what it means is we can accelerate the depreciation of the facility. So what I love to see is when an investor of ours, they get their K-1 tax statement at the end of the year, and they have all these distributions that they've gotten, which is positive cash going out into their pocket. But at the top of the K-1, it shows a very low or maybe even a negative income number because of that depreciation. And that's the magic of investing in commercial real estate. You get cash in your pocket and you don't have to pay taxes on it. I mean, that's beautiful thing, right, Bobby?
Yeah. Oh, I've enjoyed it for quite some time now, the last 3 years. And you talk about that, the time period, the intermediate time period that you have something invested in. Most of the multifamily syndications that I've gotten involved in, they have between a 5 to 7 year hold time, and I've been fortunate that 3 out of my first 4 all went full cycle in the first 2 years of my being invested. So,
right.
That's something that is a pretty powerful way to kind of get things moving. But like you said, there are some different things that you have to watch out for too. And I often have likened investing in these syndications to investing in a business. You're investing in people, and so vetting the team that you're working with is one of the most important things. But, obviously there are teams out there that should be vetted more and they're doing some different things that maybe are not the best. So if you wouldn't mind just going into some of those pitfalls that we'd like.
Yeah, I was going to say I didn't get to the pitfalls yet, but yeah, you touched on a huge one, right? So we have investors that we've worked with over the years. My partner Joe and I, we've raised over $50 million of private money over the years for our different businesses, and along the way we've met some very sophisticated, 9-figure net worth type folks, the over $100 million of net worth. And what they've told us is when they look at a deal, they, one of the things they really spend the most time looking at is the sponsor. Sure, they want to see that the numbers make sense and whatnot, but at the end of the day, that trust factor, that sponsorship situation is a huge risk in these kinds of investments. So, thankfully we've done a good job for those investors, and they keep coming back to us, which is great. And the other thing they do is they bring more money and they bring their friends. So that's when we know we're doing a good job. But the sponsor is a huge factor in these deals. So I would encourage folks out there that are looking at maybe getting out of the stock market, getting into their first alternative investment, spend a little extra time getting to know your sponsor and their background, and have they performed with this asset class before, et cetera, et cetera. What's the team behind them, all those things.
Yeah, no, I completely agree with that. And, that's something that it can be hard to do a little bit of due diligence on sometimes, finding out that information, but it's definitely worth it in the end.
I
So,
will tell you, here's a little tip, Bobby, for everybody
yeah.
out there. It could save you $50,000. All right, you ready here? Google your sponsor's name and their company. I failed to do that. This was a while back. I think it was early 2000s. It was early 2000s. I was investing in a fund or a deal or something. And I thought the sponsor was like, really, high energy, nice guy, had all the right answers. Well, it turned out he was like a felon that had stolen people's money in the past. And guess what he did again? He stole
Yeah.
my money. So I was out 50 grand. If I had just Googled his name. Now, of course, back then Google wasn't as popular. So maybe I got to give myself a little bit of a break there. But today, you've got no reason to not just, Google the name of the sponsor and the company and the
Yeah.
leadership team and, just all that and, see what pops up.
For sure. For sure. So I have to talk a little bit about self-storage in the sense of, it seems like you see a place on every corner, a new place on every corner. Self-storage seems like it's been, booming for a while. How do you see the self-storage market right now? And where do you see it going in like the next 5 to 10 years?
Sure, that's a good question. So, the demand for storage is increasing, right? So through the pandemic, a lot of folks had to end up working at home, right? So they had to turn their spare bedroom into an office. So they took that bedroom furniture and they put it in a storage unit. Similarly, a lot of millennials out there, they're not looking for the big McMansions that the baby boomers like to live in. They're looking for, maybe smaller, more manageable kind of housing because they want to go out and travel and do their things, and they also want their toys, right? They want their bikes and their kayaks and whatnot. So what millennials are doing, we're finding, is they're looking at storage as part of their overall housing strategy. So they have their home, their small home or their apartment, and then down the street they've got their storage unit with their goodies in it. So that they're definitely driving demand for storage. And then the other thing is just, our society is, a lot more mobile now than we were, 20, 30, 50 years ago. So, folks are, picking up and moving. Unfortunately, there's divorce that goes on, and, those kinds of things require, separation of, houses and goods and all that stuff. So those things end up in storage. So there's just a lot of demand drivers for storage right now. And I think, Bobby, it's going to continue into the future um, for the same reasons. I think our society is going to continue to be more and more mobile, and there's demographic trends, right? Like so, you had mentioned before we got on that you were in the North Carolina area. Now you're down in Florida. There's a lot of folks that are moving south and moving to the southeast, and so for those markets, that's going to drive all kinds of building, right? Multifamily,
Mm-hmm.
which needs more storage. I have we're here outside Philadelphia in a town called Wayne, and I have a friend of mine who's a multifamily developer in a town here called Phoenixville. And he was telling me that they build their apartments with really hardly any storage space in them. And so he's like, yeah, you should just build storage facilities down the street from where we build our apartments. I said, hey, that's a great idea.
Yeah.
But that's certain. When we're looking at a deal, we're looking at those things that are happening in the market. So we are looking at housing starts. We're looking at the population trends, employment trends. We want to see that it's a healthy market in that regard. We want to see it's a diversified economy, and so that there's lots of different ways that economy is being held up, not just one factory that could go out of business and then the whole town goes out of business. So.
Mm-hmm.
But yeah, we see storage. I guess back a few years back, maybe 10 years ago, it was maybe 1 in 15 houses in the country had a storage unit, and today it's 1 in 10. And so we think that that trend is going to continue for sure.
Very cool. Very cool. Well, myself, I'm a big proponent of utilizing self-directed IRAs to invest in real estate. So how does an investment in self-storage kind of fit into that idea of utilizing self-directed IRAs?
Yeah, it fits great. I've been a self-directed investor since 2009. I've invested in all kinds of things, and I think it's storage is a great way to utilize those self-directed IRA funds. I mean, the one small thing that you're not able to take advantage of, we were talking about a little earlier, is the tax advantages because it's already a tax advantaged account. So you kind of lose out on that, but you have a solid investment in real estate. It's cash flowing. We structure our deals so that the our investors are getting a monthly distribution. So I know in my investments in my self-directed IRA, I like to get that email every month from my custodian saying, "Hey, this payment just came in,"
Mm-hmm.
so that I know that that sponsor is out there, working for me. So I like to see that for sure. But it's we like to as we talked about a little earlier, we like to get into these investments, turn them around. 2 to 3 years is our normal turnaround time, and then we like to compound those profits into the next deal. So we have investors that keep coming back to us in their self-directed IRAs and otherwise because they like that compounding effect over time.
For sure. Well, and I've noticed too with a lot of the self-storage deals that have come across my desk, the cash flow and distributions, like you mentioned before, they're just a lot higher than a lot of multifamily investments. Whereas multifamily, you might expect a 6 to 8% distribution. You can expect higher than that in self-storage. So that's a pretty powerful thing because it helps to lower your risk as well.
Sure.
You're getting your cash back sooner, and that helps to lower your overall risk with the investment. So
Absolutely. And like we talked about earlier, Bobby, the operating margins at storage facilities are in the, 60-ish% range, 65%. So, if there is some wicked economic impact, macro thing, and, we need to lower rates, which is going to lower our revenue, we've got a lot of cushion there to make sure we can still service our debt and service our investors.
well, and I think too, one of the things about self-storage is that it is pretty recession resistant or resilient, however you want to phrase it.
Sure.
When times are good, people buy more stuff and they need someplace to put it. When times are bad, people are
Yeah.
maybe, downsizing and they need a place to put their stuff that they had before, so,
Yeah. That's absolutely right.
it works both ways. And so self-storage in general, once it's up and it's running and running the right way, it can be very lucrative in that way.
Oh, absolutely. Yeah, you hit the nail on the head. When things are good, people are buying stuff and they'll store it, and that $150 or $200 a month charge is not a big deal, and so they just let it slide. And they don't want to deal with, it becomes kind of a Planet Fitness model where, it's on auto pay, hitting their credit card, and they're like, I'll get to it next month or whatever.
Yeah.
But in bad times, people really need storage. So, if they are having to sell a house and downsize, or they're being, they're moving somewhere, they've been displaced otherwise, and things are rough, and yet people really rely on storage. So it becomes a much more higher priority budget item.
Now, that brings to mind when you talk about moving, a lot of self-storage facilities have partnerships with like a U-Haul or something like that. Is that something that you guys do with yours, or how does and what does that model look like?
So yeah, it's a good question. We actually our last acquisition was down in Cummings, Georgia, and we bought the self-storage facility that was basically started by a moving and storage guy. And so he was keeping his moving and storage business, but he was selling the self-storage business because he was admittedly not a self-storage guy. So of course his rates were way too low and all that stuff. So that deal's working out great so far. But yeah, U-Haul, we do not do U-Haul. And the reason is it's such a pain for our managers at our facilities to deal with U-Haul, make sure they have the right trucks. When someone makes a reservation, they need to have that right truck, on the lot at that time. They take up a lot of space, takes up a lot of time from the managers. And so we've just said, you know what, we're not going to deal with that. It's just not, the juice is not worth the squeeze, as they say, for our model. So I know others might feel differently, but that's been our experience. And again, that goes back to our operations expert who has been in the industry 16 years. She's seen U-Hauls just drive facility managers crazy. And it also goes against one of our core strategies, which is using more of a hybrid management model. And that's something that allows us to keep our expenses low because we don't have a full-time manager on site. We have kind of an on-demand situation with someone that might be local to that market. And so that allows us to, lower that payroll, which of course all business owners know, payroll is one of your biggest expenses. And so it allows us to do more of a remote management kind of thing. Because, let's face it, these days, everybody's renting not only storage units, but they're buying stuff on Amazon, whatever from their smartphone. So at our facilities, you can go on your smartphone, you can rent your unit right from there, and you don't even have to come in contact with anyone, which in our during COVID was a huge selling point as well. And now it's just continuing that way.
For sure, man. That's fascinating, though. I mean, because the systems that you have to have in place for that, that's a really cool model, I think.
Yeah, we definitely maximize the use of technology. There's a lot of great management platforms out there for self-storage. So we use those and we track our key performance indicators in there and all that good stuff. So it's a really tight ship here.
Awesome, man. Well, this has been a wonderful conversation. And I do want to give the listeners out there a chance to reach out with questions or comments for you. So how can they go about getting hold of you?
Sure, absolutely. Well, I'd love to hear from anybody that wants to learn more about storage. Best place to start is at our website, belrosestoraregroup.com. And if you don't mind, Bobby, I'll just tell everyone about a resource that we have there, in which we actually touched on earlier, was just how to, the questions to ask your sponsor, et cetera. So we have a resource that we call Safe Investing. It's available for free on our website, just as a value add, give back to the investor community out there. And basically, it's a book that is a culmination of our experience as investors over the years. And it's called Safe Investing. Safe is an acronym. S is for sponsor. So it gives you a whole list of questions to ask your sponsor. A is for asset, gives you a whole list of questions to ask about the asset that you're investing in. I'd love to see like a crypto investor answer those questions because I have no idea what asset is backing up those investments. F is for financials. What are the financial projections? What are the returns? Do they fit my personal investing criteria? Because most investors are looking for some combination of income, growth, or capital preservation, or hopefully all three. And then E is for exit. How do I get out of this thing? Like we talked about earlier, you can't just go to schwab.com and click and sell your position. So you need to be comfortable as an investor knowing that your money is going to be tied up for a certain period of time. And how do you get your money back? What is that event that's going to cause that to happen? And is it reasonable and believable? Yeah. So I invite folks to go there and pick up that free resource. And there you can also sign up for our investor portal, and that's where you can learn about all of our upcoming self-storage opportunities and reach out to me directly.
Very cool. Well, Tom, this has been great. I really appreciate the time that you spent with us, and I'm going to make sure that we keep in touch here.
Yeah, sounds great, man. Appreciate it.
All right. Thanks a lot.
Thank you.
I had a great time getting to know Tom during this episode. Self-storage is an opportunity that I've heard much about over the last several years, but it's a challenge to get into sometimes because it's so fragmented. As with any investment, it's important to know who you're getting into business with. A bad operator can lose you money on a seemingly good investment, while a great operator can save your money if things happen to go sideways. That's going to do it for today's show. If you'd like to learn more about Tom and his self-storage investments, make sure you check out the show notes for his contact information. This is Bobby Jones signing off. Until next time, be safe and take care of each other out there. Thank you so much for joining me for another episode of the Plan B CRNA podcast. If you haven't already subscribed and reviewed the show, I'd be honored if you took the extra time. It really helps to expand our reach and get the word out about the show. If you're a CRNA who is interested in sharing your story on our podcast, I'd love to have you. Please email me at bobby@oncallinvestments.com for more information. This episode was brought to you by On Call Capital. They are dedicated to helping providers like you develop passive income and generational wealth through investments in the apartment and alternative investment spaces. Feel free to check out their website at www.oncallinvestments.com and subscribe to their free educational email series. You can find On Call Capital on Facebook, Instagram, and Twitter. You can also check out our YouTube page, where you'll find all of the show episodes along with other educational videos. Thanks for listening, and we'll see you on the next episode.